What's up, everybody? Welcome back, or welcome to the Stock Trades YouTube channel. My name is Dan Kent, one of the co-founders of stocktrades.ca. On this channel, we focus strictly on Canadian stock research and general investment strategies. This video, I'm going to go over two potential opportunities in the Canadian market. One of them is a contrarian play in the airline sector, and another one is an opportunity in the packaging sector, which this company should be able to benefit from a surge in e-commerce popularity. So that being said, let's take a look and see if I think these two opportunities are buys right now or if you should be avoiding them. Let's go. So just a quick mention before we start. Again, if we hit 10,000 subscribers, we're going to be giving away $1,000 worth of Stock Trades premium memberships. So smash that like button, head down below, subscribe to the channel so you don't miss out. The first stock we're going to talk about today is one that operates in the airline sector, but not in the way that you would think, and that is CAE Incorporated. They trade under the ticker CAE on the TSX. So what exactly does CAE do? Well, they essentially provide training services to both airlines, the healthcare sector, and even military defense spending. This is not a company that takes customers from point A to point B in terms of airlines. They instead train pilots, crew members, flight attendants, mechanics for airlines, things like that. In fact, the company states that on an annual basis, it will train over 220,000 of these. So prior to the COVID-19 pandemic, this was a very well-run company. It was a Canadian dividend aristocrat, but it had to suspend its dividend in 2020 just because the impacts of COVID-19 were so severe. Not only did their airline revenue absolutely crumble due to airlines not being in business, not operating, they had nobody to train, they had no need for airline mechanics on the ground to fix planes. Their healthcare and defense contracts were significantly impacted as well. And you wouldn't have thought that their healthcare was impacted that much, but the fact is, the healthcare industry essentially put training on the back burner, and they instead put the main focus on saving lives. And in terms of defense spending, these are all government-related contracts, and the government was doing much the same in terms of the CERB, in terms of trying to get Canadians to abide by regulations and rules during this pandemic. Defense spending kind of went on the back burner, and they ended up delaying a lot of CAE's contracts. So as a result, both their top and bottom lines were materially impacted throughout the year. But the thing is, it actually looks like there is light at the end of the tunnel when it comes to CAE. If we compare this latest quarter's earnings per share, they lost 2 cents a share, whereas 1 year ago today, they posted earnings per share of 28 cents. This is essentially a company that went from a profit to essentially break even in its most recent quarter. And if we look to an actual airline company like Air Canada, which has lost $12.50 per share through the first 9 months of 2020, this is a drastic difference. A company like Air Canada is struggling exponentially more than a company like CAE. And if we look to the company's book-to-bill ratio, it comes in at 0.95 during their most recent quarter, whereas 1 year ago today, it sat around 1.11. And if you don't know what a book-to-bill ratio is, in the simplest terms possible, it's essentially a metric that you can use to judge the demand for a company's product. A book-to-bill ratio below 1 will essentially say that CAE is supplying more product than there is demand for the product, and a book-to-bill above 1 will essentially mean that CAE cannot supply enough product to meet the current demand. So considering we're in the midst of a global pandemic, a book-to-bill ratio of 0.95 actually isn't all that bad. And I would actually expect that CAE will return to a book-to-bill ratio of above 1 relatively quickly. So obviously we can expect CAE to remain trading at a discount compared to its pre-pandemic crash, all while COVID-19 continues to wreak havoc on the airline industry. But there was one catalyst recently that ended up shooting this stock price up in value, and that was the early November vaccine news. If we look to CAE's share price, we can see that it lost nearly 60% of its value from pre-pandemic prices to bottom crash prices. And then we can see throughout the course of the year, it traded relatively flat. It was pretty stagnant up until early November when the news of the COVID-19 vaccine rolled out, and this stock quickly gained a ton of value back. Obviously, this vaccine news was extremely good for airlines, and it was extremely good in return for CAE. But in my opinion, this run-up is much too soon and much too fast. CAE is currently trading at 44 times forward earnings and 3.2 times sales. This is an 87% premium and a 45% premium to what this company has typically traded at over the last 5 years. A lot of people bought this company up. They scooped this company up when news of the vaccine had come out. My overall thoughts on this is that it is going to take this company a lot longer to recover than people thought. I truly believe that COVID-19 will subside at the end of 2021 and life will get back to somewhat normal. The issue is a lot of these airlines are going to be in such rough financial shape, like Air Canada, that they will likely put any training they can on the back burner. And who truly knows if airline travel will get back to pre-pandemic highs? I mean, you've seen Air Canada themselves say that it's going to take 2 to 3 years to get back to 2019 revenue. So as a result, Air Canada and other airlines may either not need the level of training they did pre-pandemic, or they may simply cut costs in this area and only train the necessities. As a result, I see CAE recovering at a much slower pace than those who scooped this company up back in November think they will. This is a company that is trading only 17% off 2020 highs, despite seeing revenue drop year over year 22% and operating profits absolutely collapsing, coming in 77% lower year over year. In my opinion, this is a contrarian play in the airline sector that is going to require a ton of patience. For me, I wouldn't be buying this company right now unless I had a really long time horizon and a ton of patience, because it might not be as quick of a recovery as you truly think. So moving on to the next stock I want to speak on, and this is a stock that operates in a very boring sector, and as a result, it was a value play on the TSX for a very long time, and they actually stand to benefit quite a bit from the boom in e-commerce. That is Intertape Polymer. They trade under the ticker ITP on the TSX. So as most things go in the stock market, a stock garners no attention until it soars in price, and then it seems like everybody starts talking about it. And that was actually the case with Intertape Polymer earlier this year. This is a stock that was trading at some pretty depressed price levels until it posted an excellent earnings quarter, which saw its price shoot up considerably. So now we're getting a ton of inquiries as to whether or not this stock is still a buy. So what exactly is Intertape Polymer? Well, they are one of the world leaders in the development, manufacturing, and sales of paper and film-based pressure-sensitive and water-activated tapes. And along with that, the company also deals with packaging products for both retail and industrial purposes. They have operations in North America, Asia, and Europe, although its European exposure is somewhat limited, with only a single factory out of the 31 total being in that country. So this is a company that does operate in a cyclical industry, but it's somewhat offset by the amount of industries that they do have exposure to. This would be oil and gas, food packaging, medical supplies, aerospace, and most importantly, moving forward, e-commerce. Now, this does sound pretty crazy, and this is something you just simply don't think about when you're looking at exposure to e-commerce. But this is a company that essentially makes the tape that tapes up these parcels that are getting shipped to Canadians, to people around the world at an insane pace right now. And this is a company that could benefit significantly from a demand in e-commerce sales. And this isn't just my opinion. This is straight from the CEO of the company. And here's a quote from their most recent earnings report from Greg Yule, the CEO. The pandemic has impacted businesses differently depending on the markets they serve. What is becoming clear to us is the structural change underway in e-commerce. Increased demand in e-commerce and building and construction, as well as a return to positive performance in most of our other markets, drove increased growth in both our top and bottom line results and our ability to generate cash flows. So as I said, again, when people want exposure to e-commerce, they often go to companies, expensive companies like Shopify and Amazon. Companies like this stand to benefit significantly in terms of revenue generation. No, it's not going to be as drastic as a company like Amazon or Shopify, but you have to understand you're paying significantly more for companies like this. And if we look to Intertape Polymer's stock price, we can see that for the better part of 5 years, this company was on a significant decline until it reported earnings in early November, when the stock absolutely skyrocketed, gaining nearly 50% in just a month. And as a result, there's a lot of investors who are wondering if this is still a buy right now. And I actually think that Intertape Polymer may still be trading at a discount right now. So this is a company that's expected to grow their top and bottom line by around 10% in 2021. And if we look at forward price to earnings, this is a company that's only trading at 11 times forward earnings. If I'm seeing double-digit top and bottom line growth, I'm more than happy to pay 11 times forward earnings. And this is actually still a 15% discount to what this company normally has traded at over the last 5 years. This is a good price to pay just for the growth alone. But if we look to the dividend, it gets even better, because Intertape Polymer does pay a dividend yield in the low 3% range and actually has a payout ratio that is only 45% of earnings and 27% of free cash flows. They haven't raised their dividend consistently over the years. The company takes a very defensive stance when it comes to earnings, so I'm not sure how much you'll get in terms of dividend growth out of the company. They did raise last year. The fact is, they're pretty cheap right now, and they do offer a very reasonable dividend. So yes, most of the value in this stock was achieved earlier in the year. You did miss that opportunity. There is not as much upside potential in Intertape Polymer right now, but this is likely a Canadian stock that has the chance to keep up with the TSX, if not outperform it moving forward, all while you get to collect a 3% dividend. So overall, I'm not crazy about CAE right now. This is a great company, but I really feel that their stock price has gone up just too much too fast. This is a stock I'd be putting on my watch list, though. Maybe it takes a dip in the future. And Intertape Polymer, although it's not going to provide explosive returns, this is definitely a stock that you could consider taking a position in right now. It operates in a somewhat boring but somewhat reliable business sector, and if you're looking for an outside play in e-commerce, they definitely could be it. So again, if you like the video, smash that like button, subscribe to the channel, and once we hit 10,000 subscribers, we cannot wait to give away $1,000 in Stock Trades Premium subscriptions, and we'll see you next time.